If you've changed jobs a few times through your working life, you might find yourself with multiple super accounts. UniSuper reported in November 2023 that 4 million Australians have more than one super fund. Welcome to Dollars and Dreams, the podcast designed to empower you to take control of your personal and business finance. You know, the very thought of money and finance can often send chills down your spine and stir up fear of the unknown. But let's change that narrative together. Through this podcast, my goal is to not only to provide you with useful information, but also to inspire and motivate you to take action towards your own financial goals. Let's rewrite your money story together. Hello and welcome to today's episode of Dollars and Dreams. In today's episode, I'm going to talk to you about consolidating super. I know I've done a few topics on super over the last few weeks, but for me, super is such an important part of our financial security, and I don't think people take enough interest in their own superannuation. So today I'm going to talk about consolidating. And of course, you know, we all know people that have more than one fund. And you hear all the time from anybody that's in the financial world about consolidate. But firstly, some people don't even know what consolidating is. Secondly, people have no idea how to do it. And thirdly, consolidating might not always be the best thing for you to do. So I'll talk about at the end of the episode a bit of a checklist that you should do before you consider consolidating your superannuation. And as I said in the intro, UniSuper reported that in November 2023, there are 4 million Australians that have more than one superannuation fund account. That means 4 million Australians are at least paying double the fees that are in their super funds. Some people have got more than two. You know, over the years, I've seen somebody that had 3 and 4. And so there is a reason to consolidate if you can. But firstly, let's talk about what consolidation is. So really what consolidation is a nice simple thing that you do where you roll your money out of one superannuation fund into another superannuation fund. Consolidating super is important because it gives you control over your money. But the thing that you've got to remember is it's not you withdraw the money and then recontribute it. So if you had 2 separate bank accounts, you would just pull the money out of one bank account and transfer it to the other. Consolidating superannuation has to happen between one superannuation fund and another superannuation fund. So the fund that is going to get your money sends a form across to the one that you're going to move it out of, and they ask for it to roll over. The reason that they need to get that form from the fund that you want to close is because whatever categories your superannuation is in that original fund, it has to come across to your new fund in that same classifications. So, of course, you've probably heard me talking about, and if it's not on podcasts, it's certainly on our videos on our website, jenrichardson.co. So you would have heard things like I talk about what's the difference between concessional and non-concessional contributions. We have different components inside your superannuation, so they're different buckets basically. And so those buckets have to go across to the new fund in the same buckets. The reason that they do that is so that the integrity is maintained, because of course if it's a taxed or what we call a concessional contribution, the government's already collected tax on those money. So it comes across to your new fund as a concessional contribution. And of course, there are caps with how much you can put in, particularly your non-concessional or the after-tax contributions. So there's caps at the moment that's $110,000 per year. So it stops you rolling funds and then being able to access those caps again. So why should you consolidate? Well, that's one of the questions we get asked all the time. And the first thing I always say to everybody is, one, because every superannuation fund pays management fees or administration fees or both. And so if you've got 10 funds, you're paying 10 lot of fees. Whereas if you have all of your money in one bucket or one superannuation fund, you're only paying one lot of fees. Now, depending on your super fund, some super funds will have higher fixed fees. Some will have higher fees based on the percentage of, based on the amount of money that you have in your superannuation fund. So consolidating means that less money is going out to super fund managers. And so obviously the less money that goes out, the more money you have that's invested, the more money that compounding interest can work with, and the more money you will have in retirement. So paying out money to, 5, 6, 7 or however many super funds you've got, paying that money out to administration fees and management fees just means you're throwing money out the window. It's money that you're giving away to a business, and don't think that a super fund's not a business, because they are. So you're giving them your hard-earned money that you don't necessarily have to. So the other reasons that you should consolidate is that you don't lose track of it. So much money in superannuation is lost, and a lost super is a classification, and that is where you've had no contact with them for 2 years, they've had mail returned, there's been no contributions go into your fund, and the trustee believes that they can't find you anymore, particularly if you move houses, which we tend to do. So consolidating your super means that you've just got one superannuation fund to notify when you move addresses. You can move your super funds from job to job. And we had a client this week that he's only quite young, and he just got a new job, and his new employer told him that he couldn't use his current superannuation fund. He had to use theirs. Now, we just said to him, go back and tell them that's not the case. He doesn't have a lot of money in super, so he was in a fund that didn't charge any fees at all if the balance was less than $5,000. So we didn't want him adding to another fund that didn't have those fee reductions. So we just said to him, go back to your employer and tell them that under Super Choice, you get the choice of where your super goes. That is slightly different if there's an arrangement with an EBA in place, but for most of us, we get the choice of where our super goes. So when you change jobs, you tell them your same super fund, and that way you only get the contributions going into one fund, not a whole heap of them. The other thing that we get asked quite often is, what happens if I don't know where my super is? Particularly people that are older, like myself. When I first started, when compulsory super first started, I'd been working a few years. I think I was in my mid-20s when it came in. And back then, it was your employer chose the fund. So if you were one of those people that worked lots of different places, you probably had lots of different funds. You probably can't even remember who they are. Or even if you can remember who they are, they may not be called that anymore. They might have merged because, of course, there's lots of superannuation funds merging at the moment to try and reduce the overheads that come with managing funds. So if you can't find your super, or you're not sure where your super is, you can go to Money Smart, which is a government website, and you type in the search engine Lost Super, you put your name in, and it'll tell you if you've got any superannuation. You can also fill in a form and send it to the tax office. Unfortunately, the tax office does need that form filled in, and they will do a search for your super. Back when super first started, we didn't have to give them too much details. We pretty much just gave them our name, our date of birth, and our address. So if you changed your name, you moved addresses, back then I don't even know that they collected email addresses. At least now with our superannuation, we put our tax file number on it. And the reason that we do that is because we have our tax file number for life. It's irrelevant what our name is, where we're living, or anything. So if your superannuation gets lost now, generally it goes back to the tax office, who then will match your tax file number with their tax records, and they will track you down that way. So remember, go to Money Smart, which, as I said, it's a government website, so it is a nice, safe place. Put your details in to see if you've got any lost super. If you do have lost super, follow the steps that's there. Contact whoever the fund is with, or find out where it is. But if you need more help with that, please reach out to us here at jenrichardson.co and we can show you how you get back in touch with that super fund or track where your money has gone, because it may very well have gone to the tax office and it's sitting there waiting for you to claim it. So the other question we get quite often from people is there age limits for consolidating super? And the answer to that is no. So even if you've gone to pension phase and you've got a couple of different superannuation funds, you can still roll across into one. You don't have to be in what we call accumulation phase. So accumulation phase is where you're earning money into your superannuation fund, so your employer or yourself are contributing to it. Pension phase is when we are in retirement and we're starting to pull the money out of our superannuation. So quite often we will see in pension phase, that's when we do a bit of consolidating with people if there was something in there that we wanted to keep. So there might have been some really good insurance policies that we wanted to keep and we couldn't get them anywhere else. So sometimes we'll wait till people are in pension phase to actually consolidate. And that brings me to a question that I'll cover a little bit further on, is what things should we look out for before we consolidate? Because it's always look before you leap when it comes to consolidating your super, because you can't uncook a chook. So if you've moved your super and you've lost things that's in it, bad luck, it's gone. You can't undo it. So there are some important steps and I'll go through those a little bit later on. So what are some of the advantages of consolidating your super? Well, other than those that I've just talked about, in that you don't lose track of it, you pay less fees, it's easier for you to manage. So instead of looking up 4 different funds to see what your balance is, to see what their performance has been like, to see where your money's invested, you've only got one to look at. And now most superannuation funds will have apps, which makes it much easier for you to track your super and track its performance. Remember what I said in one of my earlier podcasts about the government issues a naughty and nice list every year. So it's important when you're managing your super that you go and check the naughty and the nice list to see where your super sits. Having one super fund as opposed to multiple will also reduce the paperwork if you've got to do anything. So we talk about binding death nominations that we should all have on our superannuation fund, because of course if you're not quite sure of this, certainly I cover it in videos and things, that a superannuation fund doesn't form part of your will. So whoever you've left to administer your will, so your children or your spouse, they can't control your super. The trustee of your superannuation fund determines where it goes. So a binding death nomination form is where we tell the trustee where we want our money to go. And it's the equivalent of a will that we have outside of superannuation. So if you've got 4 different funds, you've got to keep your nominations up in 4 different places. And of course, if you put a binding death nomination in place and it's a non-lapsing one, which means that it's there for life till you tell them otherwise, and you separate from your spouse, if your binding death nomination says that it goes to your spouse, even though you're no longer together, that's where your money's going to go. So you might remember to change your will and take your ex-spouse out, but not too many people will think of the next step, which is changing the binding death nomination with your super fund. And of course, if you've got 4 of them, you need to redo 4 of them. So there is reduced paperwork. It gives you more control. Some superannuation funds do what we call risk profile. So that's how risky your investment is. So the older you get, the more conservatively they start to invest. So they're called life cycle investment strategies. So when you hit 55, they might reduce it to a little bit more cash. Now, if you're not one of those people that wants to be in a conservative investment, even though your super fund may think that's what's best for you, it's up to you then to notify your superannuation fund. And I just did this recently. I just looked up my super fund because that's what I do quite regularly. And I noticed that they'd moved me into a balanced superannuation investment strategy. That's not what I wanted. But because I've only got one superannuation, it was nice and easy for me to fill the form in to notify them of how I wanted my risk profile investment to be, which, I can't disclose that here because that inserts an influence and it shouldn't. But I'm not a balanced investor. So I had to lodge a form with my superannuation fund, which they then had to accept and then change the investments into how I wanted it invested. So if I had 4 investment super funds, I would have to lodge those forms with 4 funds if they all did those life cycle investments. So there's less paperwork when you go to pull your money out in retirement, which ultimately is what our superannuation is for. You would need to fill in 4 applications to get your pension payments. You've then got 4 funds that you've got to notify, because with your superannuation, once you start to draw it down, you need to take a minimum of 4% a year and a maximum of 10% a year. So you would have to do some juggling to work out how much money you wanted in retirement, which means then you've got to work out how much, between your 4 and 10% is out of those 4 or 5 funds that you've got, to work out whether you're going to have enough money. Now, if you just automatically did a straight 10%, you might have pulled out more money than you needed, which means then you've lost the opportunity for compounding interest inside your fund. So there is definitely less paperwork. There's also, it makes it easier in one fund to do more retirement planning. So you can do projections forward in one fund much easier than you can in 4 different funds. So you can look at your balance. You can do, most super funds will give you some sort of projection to what your balance will look like at the age of 67, which is the current retirement age. For age pension anyway. So they'll do projections forward. But if you've got to add things, all you've done is complicate what you need to do. And for anyone who knows me, I work on the KISS theory, that keep it simple, stupid. And so if you only have to look at one fund as opposed to 4 funds, that makes your financial life so much easier, and it gives you better control. It also does lessen the risk that you'll have lost super, because if you've only got one fund, then of course you're more aware of it, and it is quite difficult then for one fund to become lost, because there is certain criteria, as I said earlier, got to be no contact, return of mail, no deposits go in as contributions and things like that. So if you only have one fund, it is less likely that you will have lost super and therefore lose money in unclaimed super. It also makes it easier for you to check the performance. So if you've got one fund, it's nice and easy for you each year. And, your superannuation fund as a minimum should be an annual checkup. I always say to people, really, you should be checking at least each quarter. One, because you want to make sure that your employer has put their superannuation in and put it in on time. And of course, your superannuation, if you're not quite sure, so your employer super contribution needs to be in your fund 28 days, and that's talking about in your bank account in the super fund, 28 days after the end of September, December, March and June. So you should be checking to make sure your employer has put your superannuation in, because you don't want to be working for them for years only to find out somewhere down the track that they haven't been contributing to your super. They may have gone under, and then it's a huge fight. Because remember, your superannuation is something that your employer needs to pay. It's not an option, and it's part of your employment role that you be paid that the same as your wages. So I always say everybody should be checking their super fund at least quarterly. 1, to check, as I said, that the super's gone in. 2, to check that it's vested correctly. 3, just to look at what the performance of the fund has been. And there's lots of other things that you can get from that. Check that your insurances, if you've got any in there, have been paid, because sometimes things fail, and then you don't want to be relying that there's been an injury and you think you're going to start getting paid some of your insurances that you've got in super, only to find that you don't have them. So knowledge is power, and you should be taking an active role in your superannuation. And that, of course, is much, much easier if you only have one fund. So I did say at the start of this podcast that I'm going to go through some of the things that you should check before you consider rolling your superannuation. So the first thing you need to check is, firstly, have you got any lost superannuation, to make sure you grab it all at one point. Because I've seen people roll superannuation into a new fund only to find out a bit later that they've got another one, and then they just don't want to do it again. So if you're in that stage of consolidating your super while you're in that paperwork phase, just do it all in one go. So do a check of any lost super firstly. Find all of your funds by doing a search for any super funds that you may have. You can also go onto your MyGov site, and it will list any superannuation funds that the government knows you own. So you may have forgotten that you've got one from an employer 4 or 5 years ago. If you have a look on your MyGov site, it will be there. So before you consider which one you want to roll to, and most people's reaction is to roll to the one that currently your superannuation is going into. And, that might be the right one, but it may not be. So you should check that you are going to the fund that you want or your contributions to go to moving forward. So again, that's going back to that naughty and nice list. So if you've got 4 funds, find out which one has been performing the better. Find out which one has the lower fees. And of course, the first thing that you need to check is which one has any insurances, if anything. Because as I said earlier, you don't want to roll to a super fund that you have chosen to roll to, only to find out that a fund that you left, you had insurance policies in it, and now you've got some different health conditions and you can't get those policies back in place. So rolling your superannuation before you check your insurances can be a really, really expensive operation for you. Remember what I said earlier, you can't uncook a chook. So if you've rolled your superannuation out of a fund with insurance policies in it, you can't all of a sudden go back and go, sorry, didn't mean to roll my super, but can you put all those insurances in place because I can't get them anywhere else. They're going to look for any opportunity to reprice you because you now are more of a risk. And of course, that's where superannuation comes in. So if health matters have come up since you took out those insurance policies, they're going to reprice it because you now are a greater risk, and the repricing will reflect that higher risk. So check your insurances, check which fund performs better, check the fees in the fund, because, one of the things that we see everybody says to us is, oh, my fees in Fund A is much higher than my fees in Fund B, so I'm going to roll into Fund B. But Fund B may not be performing all that well, and you may not get as great a return on your investments. So you have to remember that it's a holistic approach to it. You've got to look at the performance and the fees. And if you're paying more in fees but your performance is much, much better, you may be better off to pay the higher fees to get the better performing fund. You also need to check the type of super fund that you're considering rolling into. Not all super funds will accept funds from money from everybody, although now most of them do. You also need to look at the advantages and disadvantages of being in an industry fund as opposed to a retail fund. So industry funds, of course, aren't as transparent, so you don't actually know where your money is being invested. If you want to have more control over the type of investments that you have, you may want to be in a retail fund which will have higher fees because they're an investment house, as opposed to an industry fund which is more reinvesting it back for members. I think I said on an earlier podcast, and if I didn't say it, I'm going to reinforce it here. An industry fund, where it says it reinvests the profit back for investors, does not mean that it doesn't pay costs. So it still has advertising, it still sponsors sporting events, it still pays executive fees and wages and bonuses and things like that. A profit is income less expenses. So all they're talking about is that profit after the expenses have been paid will be there for members' benefits. So don't confuse we reinvest our profits with we don't have expenses, because they do. Some of the other things that you should consider is, the flexibility around that. Are they easily accessible? Do they have an app? Because most people now don't want to wait for snail mail to tell us what our fund balance is or what the performance has been, because of course by the time we get our members statement, sometimes it might be 2-3 months after the close of the quarter or the 6 months. And you want to be able to take an active role in that. So look at things like, do they have an app? Is it an easy to use app? Do they have great phone support if you need it? We've got, through our business here, we deal with lots of super funds, and there's some super funds that their phone support for us as advisors is just awful. They're all working from home, so there's no communication. They take ages to come back to us on an email. And that's not a great option for us as financial advisors, because it means we can't make timely decisions for our clients. So if you're a person that wants that approach, wants some help, wants some guidance, and needs some support, have a look. Have a look and see what their ratings are. Have a look at any comments on the funds, or reach out to us and we can talk you through any of that. So consolidating super, just to wrap up, is a super important part of your financial journey. It is a way for you to have more control over your money and your finances, but there are some traps to it. So make sure you do your homework. Don't just jump in holus bolus. And definitely don't listen to everybody else that says, oh, this is where you have to do it. Or, you hear it on social media all the time. These people going, consolidate your super, you're going to save all this money. Yes, you may, but you need to make sure you have marked off all those steps of what need to be done. So we actually have a checklist of superannuation and things that you should look at before you consolidate your super. So put a comment below, or reach out to us and we can get that checklist over for you. It should be on our website. It should be a link in where you're watching these podcasts, and you can get that checklist. So if you have any questions, please reach out to me here at jenrichardson.co. I hope you've learnt something from this, and I hope that this makes you aware of what you need to do before you consolidate your super. Not saying it's not the thing that you should do, but you need to make sure you've ticked all the boxes before you roll it, because you cannot get back to where you were before if you make a mistake. So thanks for listening today. I hope that I have added to your knowledge base about super. I've got a great superannuation course coming up for women on my Got Money Honey website soon, and that's called Super Savvy Woman. It's an 8 self-paced module course where you'll have lifetime access to that course. We've got all the tools and templates you'll ever need. So it's going to have things like the risk profile questionnaire so that you know how your superannuation should be invested. There's all the support with me through our Zoom calls and through our private Facebook groups. So if you want to take control of your super but you're not sure where to start, come join me over at Got Money Honey, and you'll find that on my website, jenrichardson.co, and come join Super Savvy Woman, and so that you can give yourself the life that you want in retirement. So that's it for me. Thank you for listening to me today, and I'll look forward to seeing you next week on Dollars and Dreams. Remember, the advice shared in Dollars and Dreams is general in nature, and it does not consider your own personal circumstances. Dollars and Dreams is for educational purposes only and should not be relied upon to make investment or financial decisions. If you need more help, please reach out to a financial advisor for tailored personal advice. Don't forget to click that subscribe button so you don't miss out on future content. And please leave me a review. Your feedback really helps me to reach other people chasing their money dreams. You can find me over on Facebook and Instagram to connect with me. You will find the link in the bio or head over to my website at jenrichardson.co, where you will find free content and learning tools.